big headline was that the government has accepted the suggestions of the Kirit Parikh panel on gas pricing. To discuss it in detail on the new revision in the gas pricing norms, we have Kirit Parikh, the chairman of the Integrated Research and Action for Development. And we also have Harshvardhan Dole, who's the vice president of Institutional Equities at IIFL, joining us now. Gentlemen, morning to both of you. Mr. Parikh, good morning. The last time we chatted, you mentioned that these will definitely go through. It's just a matter of time. But tell us on the new gas pricing norms, what are your thoughts? Anything that should have been added? And I also understand that the policy has not mentioned pricing freedom anywhere for APM pricing. Would that be a bit of a concern for you?
No, I think it is the APM prices recommendations that we had made were following that it should be fixed within a floor and a ceiling price. And that is accepted by the government. The same floor and ceiling we had suggested, $4 per million BTU and $6.5 per million BTU. At the same time, the gas price for APM gas has been linked to the import price of crude oil in the previous month, and that is what has been done, and that has been used to set the price of gas, which is around $8.35. But because of the ceiling of 6.5, APM gas is now at $6.5, which is less than the current prevailing price of more than $8. So I think the consumers will are getting cheaper price for the PNG and CNG supplies. That is the piped natural gas for domestic users and compressed natural gas for transport sectors. That is now cheaper than what it was 3 days ago.
And
the second
sorry, go on, sir.
The second measure the government has taken is that it has provided 20% additional money or price increase for gas that is produced by ONGC and OIL from fields which are not part of the allotted fields, but other fields that they own. And from that, whatever they produce, they will get 20% more price. So that's why I think that they have not yet taken any decision on total pricing and marketing freedom for the rest of the companies. But I think that the price that they have said would sort of help benefit others as well.
Okay, Mr. Parikh, first of all, congratulations on these recommendations going through as you'd suggested. We spoke last week as well when there was a bit of a sort of doubt whether they'd be taken up, but you sounded confident that they will be, and they have been. So congratulations again. Harshvardhan, good morning. Now, what does it mean for city gas companies? Because this is straight away a complete pass-through, right? Does it come through? Is the benefit will come through via higher volumes? What's your sense?
Well, firstly, sincere congratulations to sir for recommending such balanced report to the government and government accepting that. Clearly, all the city gas distribution companies, if you notice over the weekend, have cut the CNG and domestic PNG prices by approximately 10 to 12%. And that improves the attractiveness of CNG as well as domestic PNG versus liquid fuel and the packed LPG cylinder. And to that extent, when the outlook on volume is fairly robust, the pressure on raw material prices is easing out. And it appears that at least over the next 2 to 3 years, these companies are well poised to gain from the cut in the raw material prices. We continue to like these companies and think that, rather than owning some of the heavy upstream companies, whereas there is uncertainty in terms of commodity prices, it makes sense to buy these and hold for, earnings growth linked stock price appreciation. IGL actually is our top pick in the sector.
All right. Hi, Harsh. So clearly it's positive for that set of stocks. But what about the gas producers? Near-term negative, right? But overall, are you still positive on these stocks?
Well, basis the recommendation that sir has given, it appears that pari passu, there will be about 8 to 9% cut in the EPS for ONGC and OIL. But bear in mind, the earnings are extremely sensitive to the underlying oil prices. For example, a $5 swing leads to almost 10% change in the reported numbers. So these are the cut as of now. and we'll track it progressively. But having said that, see, even after the earnings cut, the upstream companies offer a dividend yield which is as high as 8 to 10%. And to that extent, these could actually be good portfolio allocations in choppy markets as we are witnessing. So I don't see these stocks collapsing like pack of cards. They may underperform the CGDs, but given the size, etc., these could be good portfolio allocations.
All right, got that. So there's no collapse in these stocks as such that you're expecting, Harsh, got that. Mr. Parikh, you spoke about how the ceiling has been set at $6.50 per MMBTU. You'd also indicated that a $0.50 increase to the ceiling every year is something that perhaps, could be taken forward. It has come in at $0.25. Will that be good enough to compensate the gas producers?
The logic behind giving half a dollar increase every year was that we were expecting at that time that the Ukraine war will come down and the international prices of gases and other things will more or less stabilize. And then it would be ideally one would like to move towards as much of a free market determined prices for all gas producers as possible. So I think $6.50 would give enough time for people to adjust to them. And anyway, if the crude price is less than that, then the domestic price will be less than this was only the ceiling that was being raised. So I think going to $0.25 increase periodically is perhaps a sensible step that the government has taken in the light of the uncertainties about the Ukraine war and the international crude and gas prices.
Got that. Harsh, what are the hurdles or problems with moving fully to this free pricing regime, you think?
Sure.
Harsh?
So in my opinion, the government should ideally move to the free pricing gradually because there are a lot of sectors which are price sensitive. And for example, fertilizers, which consume bulk of gas as of now, the prices are controlled. And to that extent, the subsidy bill for the government may actually go up. So while liberalizing the gas prices, government has actually to walk a tightrope. It has to ensure that the producers get fair compensation. But at the same time, the price sensitive sectors also don't end up paying much more. So I think the government has bought itself 2 years to ensure that these things can be adhered to, and a risk reward can be fairly maintained.
Harshvardhan, I mean, let's assume that international oil prices remain around $85 to $90 a barrel. In a sort of long-term contract with a 10-12% kind of slope to those prices be feasible for Indian city gas companies, or you think they'll have to largely depend on domestic APM gas? What's your sense?
See, if you break down the overall gas consumption in India, 50% is domestic and 50% is LNG. And within that 50%, by and large, if you were to take last 5 years average, bulk of it is coming from term contracts. And these term contracts are, combination of either Henry Hub or essentially linked to oil cargo. With the establishment of, domestic prices which are linked to Brent, I think companies' ability to import Brent-linked cargo has actually gone up significantly. And to that extent, I think the bargaining power of the domestic consumer or the bulk buyers such as GAIL, GSPC has only gone up.
Okay, all right. We'll leave it there. Harshvardhan, great to have you with us here. Mr. Parikh, congratulations once again from all of us here. Thank you very much for speaking with us here on CNBC TV 18. So that's, the oil story, which has now come to fruition in the sense that the panel recommendations have been accepted. We remember last week when we came on the first, actually, when we started the new financial year, stocks all sold off, city gas companies all sold off before recovering fully by the end of the week. And now, of course, we've got this in terms of news flow to react to. We'll slip into a quick